Good afternoon, ladies and gentlemen. Thank you for holding and welcome to the Q3 2018 results call. At this moment, all the participants are in the listen-only mode, and after the presentation, there will be an opportunity to ask questions. I would like to over the call to Ms. Stephanie Miller, CEO, and Hans Turkenstein, CFO. Stephanie, go ahead.
Thank you, operator. Hello, everyone. It's Stephanie Miller, CEO of Intertrust. Thank you for joining the call for the third quarter Intertrust results. I'm happy to be here with you. It does feel like we've just seen each other recently at Capital Markets Day, so hopefully the story is, as I called it, steady and predictable, and we continue. So our first 9 months, I want to reiterate that we've demonstrated that we are on track to deliver our guidance, again, steady and predictable. Our third quarter results did deliver in line with our expectations. The market was challenging. There was no secret to that. We explained that to you at Capital Markets Day in our previous phone calls as well. The market conditions in jurisdictions such as Luxembourg and the rest of the world were very favorable, and we've benefited from those. And we've also explained that last year was positively impacted by some one-off items which made the change in the year-to-date results for this quarter more challenging. Let's go through some of the financial highlights, which is on page 4. So our revenue increased by 2.6% on the underlying, which is 121.8 euros. Year-to-date, however, is up 3.6%, again ahead of our guidance. Growth driven by Luxembourg and the rest of the world was offset by Jersey and the Netherlands. We have explained the headwinds in Jersey and the Netherlands previously, but you are aware that the Netherlands did have its Dutch budget day on the 18th, which had an impact on that third quarter. We also had a strong third quarter last year, which was positively impacted by one-off items. So that in combination resulted in a 2.6% change in the underlying growth this year. In terms of EBITDA and margin, our EBITDA decreased 1.4% on the underlying. The EBITDA margin is, however, very healthy at 37.7%, and the year-to-date EBITDA is up 3.5%. The decrease is primarily related to an accrual of 1.3 million, which was in Q3 of last year. And then talking about the EPS of 39 cents in this quarter 3 versus 40 cents in quarter 3 2017. The reason for that is the higher tax expense in compared to the 17 results. And just as a matter of housekeeping, we just want to let you know that September 25th, 2018, we did cancel the 2.2 million shares. Total shares outstanding is 89.755. I'm turning to the next page for operational update. Executing our strategic ambitions. I'd like to spend some time and lay out the page for you. On Capital Markets Day, we've highlighted our purpose and our vision as the enablers, the navigators, and the gatekeepers. We've also highlighted the pillars of our strategy, included 1, clients and services, 2, innovation and technology, 3, the people, which is critically important, all wrapped within operational excellence. So I'd like to give you an update on those 3 pillars with the operational excellence as a wrap. Again, I mentioned our track record is steady and controlled. And for clients and services, we've secured several mandates following commercial campaigns around industry events, both in South Korea and in Italy. The net inflow for the Netherlands, although the market itself is declining, Intertrust itself has done very well. Again, we've maintained and excelled our competitive advantage. We've gained new business from equity and bond trading firms and pharmaceutical companies anticipating the Brexit. We continue to see gains in the Netherlands from that Brexit exit. We've also, in Cayman and the Americas, we've launched a new program for money laundering reporting officer. This is right in the Intertrust sweet spot. Intertrust provides services, fiduciary services across the board in the Americas, which includes an MLRO outsourcing. So now that the new AML legislation in Cayman has extended to private equity firms, we're able to offer a whole new segment of the market, new services, and we've done quite well. Innovation and technology, the second pillar that we've announced at Capital Markets Day. I want to give you the update that the conceptual design of the client portal has been completed. I showed you that. I did the demo. We also have progressed on our choice of technology partner. That technology partner announcement is imminent. We're working very diligently to get there. It's in the final stages of negotiations. The client portal is well on track to go live in first quarter, which it says early 2019, with the expectation that the proof of concept will be across the board in all of our Intertrust offices, affecting roughly about 50 clients. That's our first migration plan. Migration of data centers are on track. Cayman and Jersey remaining, but that was known and due. The IT roadmap, as we've called it in the past, still is on track for finishing mid to third quarter next year, and it continues. All of the signs on that program are green. For people, we've accelerated the performance review cycle to drive personal and professional growth. Really what that means is we're accelerating the review feedback. It's part of our One Journey series to give our staff engagement in our strategy and feedback on their performance and feedback on the results. We've engaged with a third-party provider to redesign our LTIP program to be submitted to our shareholders next year at the AGM, but we want connectivity of our people to be tied to the performance and values of our company. Again, they are fully engaged in our strategy, and the LTIP reinforces the plans that they're engaged financially as well. And we've upgraded our international leadership and development program by adding to the team, and we will begin to roll out the training leadership program in early 2019. It's being created now. All of those things, again, steady, controlled, methodical, and in line with the strategies that we've delivered to you on Capital Markets Day. And the operational excellence, I did announce that at the appropriate moment, we will announce the location of a shared services center. We've made significant progress. I have personally visited some of the selected sites, and in the next several weeks, we'll get to the next level of negotiations and hoping to announce to you by the next call that actual site. The Global Alignment Program, which is hosted by our COO at a company-wide standardization process, continues. We've already aligned many of our processes, and those will be the first ones that go into the nearshore location in 2019. So first, we're going to continue to make sure our clients are satisfied. Second, we will make execution decisions on our innovation technology and make sure our processing is standard. We will continue to invest in our people that are fully engaged in our strategy. And then we will create that nearshore location early next year. All of this allows us to be on track, as we've said, to be a tech-enabled corporate and funds solution provider. With that being said, I'm going to turn it over to my CFO, Hans, to give you more details of financial highlights. Thank you.
Thanks, Stephanie. I'm turning the page to number 7, with the highlights for the third quarter once more. There you do indeed see that revenue is up from 118 million last year to 121 million this year. On a reported basis, 3% up. On an underlying basis, 2.6% up. So there was limited impact from the dollar in this quarter. Adjusted EBITDA down to 45.9 from 46.3 last year. You do note, however, that the 46.3 was impacted by a 1.3 million windfall. So if you eliminate that, then there's an increase from 45 to 45.9. Apart from that, EBITDA margin, as Stephanie was also referring to, of 37.7 is very strong and well ahead of the guidance for this year. So we're happy with that. Adjusted net income, again, down on a reported basis from 36.5 to 34.7. If you eliminate the LTIP release and also the one-off tax credit of 1.8 million, you get to an adjusted net income of 33.4, and then you see on a like-for-like basis an increase of 33.4 to 34.7. Adjusted EPS, again, on a reported basis, down 2.5% from 40 cents to 39%. But if you eliminate the items that I was just referring to, then you actually see that EPS is going up from 38 to 39 cents per share. Cash from operating activities at 20 million in the quarter, 24 million last year. As we mentioned in the press release, the 20 million of this year included income tax payments from previous years. If you eliminate those, then you see that cash from operating activities at 30 million is ahead of the number of last year, and you will also see that reflected in the operating working capital that is sitting on the balance sheet that has gone down compared to the previous reporting period in 2017. Year-to-date performance, revenue growth at 3.6%, also ahead of the guidance. EBITDA margin at 37.4%, north of the guidance, and an increase of EPS from 1.11 per share to 1.13 per share. All in all, a quarter that we are satisfied with, and that was indeed in line with our expectations. On the next sheet, we give you the revenues by segment, both for the quarter as well as on a year-to-date basis. What you do see there is indeed the Netherlands on a standstill or even a decline in the third quarter. In the year, 0.9% decrease. We do expect that following the clarity that we now have, that the Netherlands will see some recovery. As mentioned also on Capital Markets Day, per balance, the outcome of the budget day in the Netherlands is considered a slight positive for our business, and we have also slightly upgraded our view on what it means for the fund business, where we are now more optimistic than we were at Capital Markets Day. Luxembourg continues to be on an excellent track in the year, both in the quarter as well as year-to-date, north of 11%. That demonstrates that we do have a really up and running machine over there that is operating in the sweet spot in the market, and we are looking forward to some further growth in the quarters to come there. Americas, after a slow start of the year, is now also picking up. As discussed previously, we have new management in place and also elevated our business development efforts, and that is starting to show in the numbers now, so that's very helpful. Jersey continues to have a bit of headwind following the loss of a specific set of private wealth clients. The impact of that in the quarter is close to €500,000. So if you eliminate that, then you see that the performance looks better from the face of it, and underlying we are continuing to see positive developments on the fund side, and also reasonable performance in the corporate segment over there. The year-to-date impact of the client loss is even bigger, where the impact is 1.1 million sterling, and there you see that the same as for the quarter. This is indeed a one-off item that has shown significantly in the numbers, but underlying, eliminating this one-off thing, the business is at least stable to slightly growing. Strong growth is what we continue to report in the rest of the world. We've been talking about this in the previous quarters as well. This quarter again 4.8% and year-to-date 6.1%. This quarter we saw strong performance in Hong Kong. We continue to see very strong performance in Spain, and also the Nordics business, after a bullish second quarter, continues to be at a good pace in the third quarter. So overall revenue of 2.6% up in the quarter and 3.6% up for the year-to-date, in line with our guidance, and we are still, and we will come to that later, confirming our guidance for the year on the revenue side. Then I'm turning to page 9, where we have our new set of key performance indicators. We talked about that at Capital Markets Day, and this is how we are going to report to you going forward. A couple of repetitions here. Revenue growth 3.6% for the 9 months up. Adjusted margin 37.4%. Slight growth on the FTE side, partly in headquarters and IT, partly also on the client service delivery front. Revenue per billable FTE, a number as we discussed that we are very proud of. It is a benchmark number in our industry, and it continues to grow, albeit at a modest pace right now, but this number in itself is a good indication of the quality of service that we are delivering and the way that our clients are valuing that. The next ratio, that's one that will continue to be important over the next years as we migrate into the shared service centers and the centers of excellence. Billable FTEs divided by total FTEs, currently making a bit of a step back, 74.6 compared to 76.7, and that again is caused by the investment in headquarters and IT resources, but over time you should see this one developing towards the 80% area. In line with the previous one, HQ and IT costs continue to to increase, albeit at a lower pace than in the earlier parts of the year. As we discussed also on previous calls, headquarters upgrading is completed more or less, so you will see some stabilization there going forward, and IT costs will continue to grow as we mill our way through the final stages of the IT roadmap. Then the number of entities, we will be reporting this quarter still, and then finally for the next quarter, and then we will be no longer reporting on the number of entities. But the funny thing is, today we are in essence reporting a good development on the regular entity side, where for the first time in quite a long period we are now reporting growth in the third quarter in the absolute number of regular entities. Not on a 12-month rolling basis, but the quarter in itself showed an increase in the regular number of entities. And consistent with what we have been talking about before is that the RP continues to be on a very strong increase as well. But as said, this is the one time before the last that we will be reporting on this, and then we won't mention these KPIs any longer. Working capital as a percentage of LTM revenues slightly higher than last year, but as I said, that is primarily caused by the payment of taxes from the primarily the pre-IPO period. And if you eliminate that, then working capital is down compared to last year on an LTM revenue basis. I move to page 10 for the group HQ and IT cost. I think most of it has been discussed already. Important to note for you is indeed the LTIP accrual that is included in the numbers for the third quarter of this year, at least the release there. That has had a significant impact on the numbers. Also year to date, HQ is impacted by the LTIP movements. Year to date LTIP costs are 2.8 million in 2018 versus 1.1 million in 2017, so you see an increase there as well. And for the rest, I don't think I have anything to add here as stated on this page. I move to page 11 then for the capital employed, which as previously also discussed continues to show a very stable picture. Working capital as reported slightly up, but eliminating the 10 million of overdue or previous year's taxes, it is actually going down on a like-for-like basis. Net debt going down slightly only compared to the last year, and that is primarily because we have been returning more than 65 million of cash to our shareholders this year through dividends and share buybacks. But even taking that into account, you see that debt goes down. As you know, the debt has maturities of 2020 and 2021, is bearing interest at 250 basis points over LIBOR or Euribor, but we are seeing a step up there in the next quarters of 2019. Equity also reflecting the movements, on one hand the income that is added to the equity, and on the other hand the 65 million of dividends and share buybacks that are being deducted from that. On top of that will be a further 27 million of interim dividend for the year that we announced earlier, and that will be paid out at the end of the month. Leverage ratio going only modestly down as a result of the cash that I was referring to earlier. It now stands at 3.55 times, well within our bank covenant, but still north of where we want it to be in the midterm as part of our new financial policy that we announced on Capital Markets Day as well. Moving to page 12 then, for the full year outlook for 2018, which we are once more reconfirming today. So we are reconfirming the expectation that our underlying revenue growth will be at least 3%. We also expect that our EBITDA margin will be at least 37%, and the other elements continue to be consistent. CAPEX of around 2%, effective tax rate at a nice level of 18%, and the dividend policy will remain 40 to 50% of adjusted net income, as also reflected in the interim dividend that we announced. And with that, I would like to once more hand over to Stephanie for the midterm guidance and the closing.
Thank you, Hans. So, as reported to you in Capital Markets Day, we reconfirmed the full year 2019 guidance. The midterm guidance is revenue growth at a underlying revenue growth of at least 3 to 5%, the EBITDA margin of at least 36%. The other elements that we've highlighted in terms of guidance is CAPEX to be around 2% of revenue, effective tax rate slightly higher, which is at 19%, the dividend policy of at least 40% of adjusted net income, and the leverage target without M&A at 3 times leverage. So with that being said, I conclude kind of our summary, and we're happy to take calls. Operator, please open it for calls.
Ladies and gentlemen, we'll start the question and answer session now. To be registered for the question and answer queue, please press star 1 on your telephone. So if you have a question or remark, please press star 1 on your telephone. Go ahead. The first question is from Rory McKenzie from UBS. Please go ahead.
Good afternoon. I've got 3, please. Firstly, on the Netherlands, I think you mentioned there was a bit of a one-off hit you felt this quarter as the budget day caused higher uncertainty and lower activity, but now you see scope for a better environment. Can you just explain what happened in the budget, and also do you see scope now for a big rebound or catch-up in the Netherlands? Secondly, on the margin, I think that excluding the 1.3 million gain from last year, the Q3 margins were down about 40 bips year over year, after a 70 bips underlying increase to H1. Obviously, you're investing in the business, but is that kind of margin decline year over year a fair run rate for Q4? And then lastly, just on the KPIs, can you explain the definition of high volume and low value entities, and then also explain why you don't think that entities and ARPA are important KPIs for your business anymore? Thank you.
Thank you, Rory. I'm going to take the first one and the third, and I'll ask Hans if it's okay for you to take the second.
Sure.
So you asked about the scope of the 18th in the Dutch market, and you've asked in terms of your question about rebound. So scope on the 18th, really the 18th was the clarification of one substance under BEPS/ATED1, 2, understanding the impact of, the tax change, and I'll talk about that in a second, and then 3, the clarification of what a low tax jurisdiction is and what treaty would not be honored and what would be changed. So we have clarity around all of it. 1, the corporate tax rate was decreased, so that's a positive for corporates. It was restructured, but in general it was decreased, and it's a positive. 2, the ATED1, under the ATED1 in terms of avoidance or not meeting the requirements of substance in the Netherlands was confirmed, and they've very clearly laid out. There's a 2-year lease requirement to have substance and 100,000 payroll, so that's clear. 3, the biggest impact for our business, for the Intertrust business, is whether or not what countries would be considered low tax jurisdictions and where the tax treaties would not hold. That has been clarified. There's only 8 instances where that it will not hold, that they're considered low tax entities, and therefore tax would be created, not honored at source. So all of that, plus since the Dutch budget day on the 18th, there has been some adjustments. That was the rule that was put for law for vote. There has been some adjustments, which includes an adjustment on the structure and funds. At Capital Markets Day, we highlighted that for the market of funds, it was slightly negative. There has been an adjustment to that, and we're now seeing that the Dutch government has responded, and it's continuing on par for Luxembourg and the private equity funds. So in general, the environment to do business in the Netherlands is more widely known, and it has provided clarity. The limitation of the low tax jurisdictions, or the clarification of what they are, meaning that there are only 8, is a positive, and therefore we believe we're now going to see pickup. As I've mentioned in this actual result, I've already seen pickup in terms of pharmaceutical companies and other entities and trading entities moving to the Netherlands. In fact, earlier, even this morning, we got an inquiry. So overall, as we described leading up to Capital Markets Day, the uncertainty was a heavy hang. We now have certainty, and we do believe that, if you will, business as usual. There are a ton of positive reasons to be in the Netherlands, and companies, especially under Brexit, will continue to explore the Netherlands as an alternative choice for movement. So I'm going to stop there for question 1 and ask Hans to talk about question 2.
Yep. Your question on the margins, if I got it correct, was what we think about quarter 4 against the backdrop of a year-on-year decrease in the EBITDA margin. Well, I think that the EBITDA margin for the quarter at 37.7 in combination with the year-to-date EBITDA margin of 37.4 and our reiteration of the guidance for the full year today of at least 37%, answers your question, doesn't it?
Oh, it doesn't say if Q4 will be up or down year on year, I guess.
No, and that's something that we won't say today. That's the question that we will answer at the end of January.
Okay, I look forward to that then.
The last question is the definition of low value, high volume. So look, we've qualified mainly entities in Cayman and BVI as reflected in low value. And why are they low value? It is the lowest touch point. So it's a registered office scenario where the fee that Intertrust earns is really basically a filing fee. It is the least connectivity to the firm. It is the least value proposition to the client and can be easily off, if you will, moved away. So it does not provide an end-to-end bundle. So that is how we've defined it. In general, it's something around less than 5,000 euro in terms of fees. So it is low impact. It is low considered value to the client, and therefore it is movable. What we've tried to highlight is the strength and the consistency of Intertrust is to bring operational excellence and value in an end-to-end market that is more highly regulated, such as the Netherlands, the Dutch market, the Luxembourg market, the Irish market. We've also, to offset this, registered office is a key service and we will continue to provide it, but again, it's a low touch. We've augmented our services in the Americas around fund administration and outsourcing for fiduciary. I mentioned in my opening that new activities includes MLRO outsourcing in Cayman. That's because of the legislation. The legislation has changed there to include private equity firms. So we see additional opportunities. It's just not focused on the number of entities. As our business changes, as we look at capital markets and we look at specialized services that we highlighted in Capital Markets Day, the fees that we earned are much more aligned or akin to professional services fees. They are not akin to an entity driver, which is why we're talking about the KPI elimination. We're giving you the billability per head. We're giving you the revenue per head to show that our people are highly valued and highly paid by our clients, and that's the value proposition. And it's very hard to align when you're engaged with a fund family or with a capital markets transaction that's many millions of dollars, what the value per entity is, because that is not the way it's priced and that is not the way it's perceived in the market. So we as a company, again, professional services aligned, higher value to our client, much more stable and predictable. Hopefully, Rory, that answers your question.
Yeah, that's amazingly helpful. Thank you so much.
Thank you. Operator, next question, please.
The next question is from Mr. Henk Veerman from Kempen & Co. Please go ahead.
Hi, Stephanie, Hans. Thank you for taking my questions. I have three for today. Firstly, two on your personnel expenses, on your FTEs. Firstly, Hans, you mentioned that the billable FTE as a percentage of total could move towards 80% from 75% where we're at now. Just from my understanding, will that be because you add a lot more FTE, or can we expect another round of headcount realignment when the shared services center is operational? And what is the OPEX opportunity there? And the second one is, the second one is on your personnel expense cost. When I look at your total personnel expenses and I look at your number of FTE, there seems hardly any change in terms of cost per FTE. And I was just wondering, with salary inflation basically being a large topic this year, what can we expect going forward?
Okay. On your first question, clearly, as we have been investing in an efficient overhead function over here centrally, and as we also have been investing in a highly effective and efficient IT infrastructure, that gives you scale, and that means that if your revenues continue to grow, and that's what we are predicting, we are operating in a growing market, and we ourselves are estimating that we will grow with 3 to 5% over the years to come. That means that your frontline growth does not need to be matched by back office investment. So that's why we expect that over time you will indeed see the efficiency ratio of the company moving towards the 80%. That includes the shared service centers, but it also includes all kinds of other standardization programs that we have running. And yeah, I think that is a decent number for a business like ours. On the personnel expense generally, yeah, clearly our portfolio of people is global, so that means that the numbers as reported are a blend of all kinds of developments that happen in very different geographies, and it's difficult to say. Normally you can expect that our people are being paid in line with the market. In most of the markets that we operate in, we are operating in a competitive environment, so that means that there is normally pay increases on an annual basis. That's also what we have assumed for the future, and that also has been reflected in the guidance that we were just reiterating for 18 and 19.
Okay, thank you for that. Maybe one follow-up on what you just mentioned before I go to my last question. Like in relation to the growth in revenues, as you say, Hans, if I look at your FTE, sorry, revenues per billable FTE, as you say, it's already quite high versus some of the other competitors out there. And if I sort of look back on the developments of Intertrust, I think you were always already at quite an elevated level. How much room is there still to grow the revenues per FTE? Also, if you look at the billable hours being made by the average billable FTE.
Yeah, that's where the second pillar of the strategy that Stephanie was referring to before comes into play, and that is in the domain of technology and IT, where we are indeed making use of technology to make sure that the service gets done in the same way, but by less people again, and that will clearly have a positive impact on your revenue per billable FTE. It will not be doing much more of the same with the same workforce. That's not the name of the game going forward.
Okay, well that's clear, thank you. Last question, related to a lot of questions I received from my client base and your shareholder base following the CMD. I think everyone looked back to a great CMD, but one of the topics that came back after the CMD was still in your capital allocation framework, where I received a lot of questions, especially that your stock now is rated 13.5 euros, which I think is a low since IPO, an all-time low. So during the CMD you said that Intertrust is actively looking for acquisitions again, but would also consider opportunistic buybacks. And I was just wondering, with the huge discrepancy between current trading multiples of the company in relation to the acquisition takeout multiples that we see in the markets, could you comment a bit on how management currently benchmarks M&A against buybacks, especially when your leverage will go down further into 2019, and especially given the large discrepancy, as I mentioned, between the company's trading multiples and takeout multiples in the industry?
Sure. So it's Stephanie speaking. You know, I think it's a reiteration of what I said at Capital Markets Day, and I think the question is very fair. We are very, very well aware of where the stock is trading. We fully understand where we are in terms of leverage. As you could see, we did the leverage has decreased modestly from 3.66 to 3.55. So we very much want to get to the 3.0 number in light of where there's no M&A. So the capital allocation hasn't changed. I did say very clearly that I've turned on M&A. Why? This company has to be in a position to take opportunistic investments if there is one. I also said very clearly that it will be a disciplined and measured review. We've done one small one all year, which was the Australian one, which is a very, very teeny one, and it just allowed us to do business. So the management board of the company is going to look at opportunistic moments for the capital allocation. We are very committed to lowering our leverage, which is what we've promised everyone, and we will continue to do that. We will entertain at the right moment, and yes, I'm well aware of the share price. We will entertain at the right moment a share buyback if in light of or in absence of any other opportunity. We have announced the interim dividend, and right now that is the only current announcement currently. The capital allocation methodology hasn't changed. We do look for, again, opportunistic bolt-on M&As, but those are the things that we're very, very disciplined and very specific about. I want to decrease the leverage in light of the guidance, and we're focused on all of the strategy that we've laid out for you in the Capital Markets Day.
Okay, thank you. Thank you so much for that.
Thank you. Operator?
The next question is from Mr. Konrad Zomer from ABN AMRO. Please go ahead.
Hi, Hi, good afternoon, everybody. My first question is on your full-year guidance for revenue growth of at least 3% for this year. According to my calculation, it implies an organic growth of just 1.4% for the final quarter. I'm aware that the comps are tough for Q4, but can you indicate why you would expect such a slowdown in your organic growth, and in what jurisdiction you think that slowdown might occur? My second question is on your leverage ratio, the 3.55. It was down 14 basis points year on year. If you are so committed to reducing that leverage, and if you are working towards your 3.0 target, why would this not come down a bit quicker than that? Because your cash conversion is still very good. And my final question is on the interest charges. I missed the bit that you talked about in terms of your 250 bips plus LIBOR. But can you give us an indication what your interest charges for the full year are likely to be? Thank you.
Okay. On your first question, Konrad, our guidance is at least 3%, so that does not include that we are targeting at 3%, and that also means that your assumption of this modest autonomous growth in the fourth quarter only is not necessarily correct. So we would be happy to share growth well north of over 3% with you, obviously, in January, and that's exactly what we are saying today. It should be at least 3%, not 3%. On your second question, indeed, leverage ratio is going down at a pretty low pace. And guess what? We paid back 50 million of shares to our shareholders this year, and that clearly has a significant impact on our delevering capacity. That is the only reason. Since all the other things are moving in the right direction, limited capex, working capital, generating cash rather than consuming cash, and no unusual other items there. So the reason why leverage is going down slower than you would expect is solely because of the 50 million share buyback that happened between September last year and September this year. And on interest expense, we will not be giving any specific guidance for that number for the fourth quarter. But it is indeed the details of the loan package, including the percentages on the various tranches, are extensively disclosed in our financial statements, and that should give you a good feel for where numbers might go to.
Mm-hmm. Okay. One follow-up, if I may. Your dividend payout ratio, your target range is 40 to 50% for this year, and you say it will be at least 40% for next year. Is the fact that you limit it for this year, does that have to do with Henk's question on the capital allocation and the buyback and the potential M&A, or is there another reason behind it?
Look, I think the at least 40% is a very similar thing than saying 40 to 50. We've declared immediately the interim dividend, which is at the 40. The capital allocation is consistent, so there is no other reason. It's absolutely consistent. We did the 40. We did the share buyback earlier this year that Hans just mentioned. We're committed to delivering. We will look for opportunistic bolt-on and other M&A, and if in light of anything else, we are looking for obviously organic growth for sure. That is part of the plan. And then if all of those things don't happen, we will look at a share buyback. We are steady and disciplined and very much in control and trying to do things methodically. The capital allocation program has not changed.
Right. Okay. Thank you.
The next question is from Mr. Edward Donoghue from One Investments. Please go ahead.
Good afternoon. A couple of questions, if I may. Just coming back to the Netherlands, and I totally get the point with regard to the hiatus created by the State Secretary's decision-making towards the end, middle of September. But what have you actually seen with regard to maybe work that was maybe slightly discretionary, that was put on hold waiting that decision, and the budget, and actually returning in Q4? Just to get to get an idea above and beyond new business flowing in, but from existing clients who maybe just put things on hold slightly, to get an idea of the uplift that can come through in Q4 as a starting point. And then the other one is a better understanding of the HQ and IT costs. The HQ, are we looking at that as in Q2 you guided that figure was going to be roughly the sort of run rate. It seems fairly consistent in Q3. Is that what we should expect going forward on the HQ? And then just a better understanding of the phasing of the IT, where we move from here, because there seems to be, relative to guidance, a slight undershooting of the spend. Do we see a pickup in that phasing into Q4?
Sure. So I will take the first one and the third one, and I'll ask Hans to speak with the second question. So I don't have a predictability of Q4 right now, it obviously because we're still in the middle of Q4. However, when you ask about what is the sentiment, did we see a pickup in terms of there was waiting. So we saw a very, very strong pipeline. So taking a step back, when we described what we were seeing in the market in August when we released half-year results, we said that we were just seeing things that were taking longer to land. We now actually see the pipeline picking up. We saw that in September. We now see that the things that people had been planning actually are landed, so they're executing as opposed to holding. We are seeing further activity in the Dutch market via Brexit, because all of these things are now known. So now the Netherlands are a target location for an exiting company out of the UK market, and that specifically is the trading firms that I mentioned in my release, and actually in pharmaceuticals. So that is a positive, if you will. On the third question, you asked about what are we seeing for IT in terms of, we've got line of sight for the IT program. We've got line of sight for next year, what's happening, which is the full IT roadmap. We have announced the innovation budget, which is on top. We're not undershooting at all. We will be, if you will, close to our expectations and our target, which we've announced this year. I did announce that we're very close to signing with a significant technology partner in terms of supporting us on the portal and the innovation. That's imminent, if you will. I'm hoping to announce it at the next call. So all of this, if you will, is happening, and the program of progress will continue for the midterm, as we mentioned in the guidance, which is 2019, and the roadmap, end of 2019, complete the portal, and then complete functionality. So I think all of that is just well on track. These things are big ticket items. They need thought and process. The management board with the executive committee has just created the 2019 bottoms-up budget, so it's a line-by-line exercise, which includes all of our strategic partners for technology, and I am very happy with that progress. Hans, do you want to talk about the second question?
I'll talk about HQ. What we said at the mid-year release was indeed that we expect to complete the upgrading of the headquarters function in the third quarter, and that's exactly what we have done. We are done now, but clearly that means that we have upgraded the team, and some of those people have only joined at the back end of the quarter or are still expected to join in this month or the next month. So that means that definitely Q3 18 is a good indication of where the run rate for headquarters cost might land, but you will see a little bit of an uptick still before it really is at the forward going run rate.
Again, if I may, just two other quick questions. Just with reference to the Netherlands, are you actually hiring additional personnel at this point? What is the hiring profile in the Netherlands at the moment?
We have opportunistic hires for replacing. We haven't done an extensive add to staff, so any opportunistic, legal, administrative, accounting, mid-level management, our senior management is consistent, so that's basically the hiring that's happening here.
Right, and then just looking at the regulatory environment that you had in 18 and looking forward into 19, is there a significant discrepancy, i.e. a bump effect coming through in 18 that would actually flatten out into 19, or you see a similar level of activity required?
A similar level of activity is required. So all of the regulatory things that we've been seeing, regulatory as a service, the MRO that I just announced, all of these things are annually recurring. All of these things require a input from an Intertrust, from a service provider perspective. So it's not a bump, it's just consistency. It's also taking a step back from the strategy. It is very consistent for firms when they're feeling the regulatory pressure to continue to outsource, which is a consistent thing that has to be done on an ongoing basis. So it's not, we will announce to you if it's a one-time thing, and we've done that, Previously, earlier this year, when I first joined, we announced that there was a little bit of work for UVO for an anti-money laundering directive, and that we did announce that it was a one-time thing. These things are consistent, deliverable going forward, and it continues to develop, for the past few years. So prompting additional reviews and additional activity.
Okay, thank you very much indeed.
You're welcome. Operator, time for one or two more last questions. It's almost there.
Yes, okay. And Mr. Lucas Verhani from Deutsche Bank. Please go ahead.
Hi, thanks. Two quick from me. First, on the Netherlands, you said you're already seeing a pickup related to Brexit. I'm curious to know, what are your medium-term implied for the Netherlands? Do you see growth? Do you see flat? Do you see a decline steepening or a slower decline? I'm aware you can't necessarily give us a precise answer, but any color would be helpful. And then also a better view on the performance within Americas, especially Cayman Islands versus US. What are the different dynamics there? Thanks.
All right. On your first question, we have never given and we won't give at this point in time any specific outlook on revenues or whatever in the Netherlands. So that is not what we will disclosing today. But there are, as we just discussed on this call previously, a couple of good things going on where we expect to pick up business from Brexit. But there's also movement in the other way. So it is not on our agenda for today to give specific guidance for the Netherlands revenue development over the quarters or years to come. On the Americas question, clearly the Cayman business is 85% of the business that we operate in the Americas area. It comes further with businesses in the British Virgin Islands, Bahamas, Curacao, and some business on mainland US, but that's pretty tiny. As in everywhere in our business, margins develop in line with size and as a result operating level. And that means that the business that we have in the Cayman is indeed sizable and also highly profitable.
And if I could add a little bit of color to the first point, I absolutely fully agree, Hans. We cannot give specific more guidance. But understand that the clarity around the budget day allowed the market to put the Netherlands in context. So in context with, again, I've called the countries competitive. It allowed to put the Netherlands in context with France, with Ireland, with Germany for Frankfurt, and with Luxembourg. So now that they have the full view, we are seeing the movement. What that numbers look like, we will continue to be in the market with our sales specialists. We will continue to do a good job of working with our clients and getting new clients. But at the same time, that movement from uncertainty to certainty allows you to do an appropriate comparison and to make decisions. And I think that is a positive thing.
Many thanks.
The next question is for Michael Rook from Petercam. Please go ahead.
The Dutch market, you mentioned Brexit as an opportunity for growth, and the pharmaceutical sector is doing nicely. That probably has to do with the European Medicines Agency coming to Amsterdam. Do you also see recovery or growth potential for other business segments that are not particularly linked to these two events? And the second question is for Hans. In the annual report, there's a clear breakdown of the debt components, each with their Euribor, LIBOR, and markup. And it also says that the markup can change depending on the leverage ratios. And I was curious to know what the next bracket will be for a lower markup on your debt.
I'll take the last question first, and then I'll hand over to Stephanie to talk about the Dutch environment. You are indeed right that we operate the debt with a leverage ratchet, as it is called. As you've seen, we indeed do have two tranches. The second tranche, the one that was entered into as part of the Alien acquisition, will step up to 3.25 markup under any circumstance in Q2 of 2019. So that's not leverage related, if you wish. The first tranche, which goes back to the pre-IPO period, does indeed have a leverage ratchet that will step down further below 3.
Okay, thank you.
The first part of your question is separate from aside from pharmaceuticals and Brexit, what else do I see in the Netherlands? In general, I mentioned that the original Dutch budget day included something that we found slightly negative in terms of structure of private equity funds. They've removed that, and I think we'll continue to see funds in the Netherlands. In terms of just in general distribution, the Netherlands, we see a stronger pipeline in September. We mentioned that we had really good strong market share in our last call, which was in August for our half-year earnings. So now that everything is clear, I do see more consistency. I don't see a specific event. I cannot predict that. But I think the Intertrust business is very, very well positioned to support the uptick in business now that everything is clear in the Netherlands.
Okay, good. Thanks for the feedback.
Thank you. Operator, can we just have one last question, and then we're going to close the call. We're almost out of time.
Yes, the last question is from Mr. Felix Eisel from Conduction Capital Advisors. Please go ahead.
Hi, thanks for taking my question. I have a question on your reporting. You're going to discontinue revenue per entity and going to shift to more FTE-based billable hours. Is that also a reflection of how your business is changing on the customer side? Is it more that you start to sell more man-hours, or is it moving a bit away from selling a solution? I was just curious about that, because the question would be how that would impact your ability to increase prices in the future, because billable hours or selling man-hours is typically less favorable. Thank you.
Sure, you're welcome. So I'll take that, and happy to have Hans chime in. We really want to position the KPIs so that they're indicative of the business that we have. We're talking about not providing you with that, but rather providing you with billable percentages and then per head the type of revenue, because we are much more a professional services firm. We very much have a split opportunity where we are billing per time and material, so per hourly, but we also have an opportunity to bill fixed and bundled. We mentioned in our Capital Markets Day that we are looking for bundles across our global, and that's our strength, that's our value. So in general, it's not about how we can bill, so we work with our clients flexibly, so if they want time and materials, if they want a fixed price, we also want to make sure that the bundle is capable. But at the end of the day, we also want to give them specialized services. So specialized services included, and we have produced this, it's on our website if you weren't able to join our Capital Markets Day. It's really about fund administration, ManCo, AIFM, regulatory as a service, things that are not driven by entities, just things that are just not counted. If you offer MLR services, you could say that they officers per entity, fine. But if you offer accounting for a set of entities where there's multiple SPVs and the accounting is at the master, you're not doing it by entity. If you're offering ManCo services, you're offering regulatory, it's not, or KYC or AML, it's not by entity, it's by person. So we would try to give our investors in the investment community a real fair view of the world, and we see ourselves much more of a professional services firm, and the future continues to be a technology-enabled corporate and fund solutions firm. So with that in mind, we did not want to continue those KPIs because we felt that they were misleading. ARP is going up, but the number was going down, and it always opens the questions. We think that this is a better, more standard way to deliver you the value and give you the information. Hans, if you want to add.
No, I think what you're saying is absolutely right. Over the last 3 years, we have moved from a dedicated core corporate service provider much more into a specialized service provider to also fund and capital markets. And you see that reflected indeed in RP. RP continues to go up with entities going down, partly as a result of regulation, but also if a private equity client joins, fees can be $500,000, $1 million, $1.5 million or more for a very limited set of entities. So it is simply not a good indicator of where we are as a business in the current setup anymore.
I hope that answers your question.
Yeah, I think that's fine. Yeah.
Thank you, operator. I'm gonna end for questions now. Everyone on the phone, I want to say thank you and very much appreciate you joining today and listening and asking us questions. We appreciate your time. Thank you so much.
Ladies and gentlemen, this concludes the event call. You may now disconnect your line. Have a nice day.